Good afternoon, everyone. Thanks for joining. My name is Janet Wright with FSA's Outreach Office. I have with me today Mark Dykeman. He's going to talk to us for a while today on understanding farm income averages. And before I turn it over to Mark, just a few housekeeping items. We are recording, and this recording will be available in approximately 2 weeks on farmers.gov/taxes, and I will send out an email when it has been posted. He will answer as many questions as possible during this session. Please enter your questions into the Q&A, and at the end, he will start getting them answered for you. And so with that, I'm going to turn it over to Mark.
All right, thank you, Janet. I appreciate everybody taking the time today. Um, Here in Kansas, it's unseasonably warm. It's a beautiful day outside. I would rather not be sitting inside, but we'll work through this sometimes confusing topic together. As Janet said, my name is Mark Dykeman. I'm with Kansas State University in the Agricultural Economics Department. Just want to talk to you a little bit today about income averaging. I'll warn you ahead of time that this may be a little shorter webinar than maybe what you're used to with those posted at farmers.gov. This we can go very in depth with this topic, but the calculus of all that probably is not best for a webinar. So we'll kind of keep it high level and uh, see where this takes us. So start out with a little bit of a disclaimer. The rural tax group that I'm a part of, along with Ruby Ward and many others. A portion of what we're doing, and this webinar in particular, is funded with grant dollars from USDA, and so what I'm providing to the information I'm providing to you, not a endorsement from USDA or FSA. We do work as part of a university system, extension system. So we do not discriminate in any of the terms that you can see on the screen, but we want to make sure that this information is available and accessible to anybody who might be interested. I'm also going to provide my own little disclaimer. We are dealing with an income tax topic today. I'm providing this information as educational material only. It's not tax advice to you. It's not legal advice to you. If you do have, I can answer some general questions. I'm not going to answer anything specific to situations. But if this triggers additional questions for you, then I would highly suggest that you reach out to your trusted tax preparer or tax professional to with situations that are specific to you. A little background on the Rural Tax Education Group. There is a QR code on the screen that provides a link to ruraltax.org. That site is hosted by Utah State University. There's quite a bit of material there. It's all been developed through the National Farm Income Tax Extension Committee, which I mentioned that Ruby and I are both part of. There's a lot of information on specific to ag income tax, timber, recent years, disaster losses, and government payments have been kind of hot topics. Hobby losses or farm losses and hobby loss rules have always been an issue that generate questions. There's also articles and information on self-employment tax, estate and gift tax, like-kind exchanges, which since 2018 has been altered a little bit, and also on depreciation. I'll also point out that there is a a download of a tax calculator. It's I think can be valuable in the right situation. It's somewhat simple in the grand scheme of the tax realm, but might be beneficial to some of you and to help with tax planning towards year end. Um, I've also got another QR code here that links to an article that is specific to farm income averaging on the rural tax site. So you're welcome to read that. Maybe goes a little more in depth in some areas than what I'm going to be able to today, and maybe a little more theoretical look at income averaging than what I'm gonna talk about. But I think all of us understand that there are significant fluctuations in the agricultural world. Input prices vary dramatically. Production varies dramatically. Right now, I think we're kind of staring down potential for significant drought in certain parts of the country if we're not already there. So yield and production as a result of fluctuations in rainfall can vary incomes, and of course output prices. So prices we receive for what we produce. That's obviously going to vary from year to year, and even can vary significantly within a year. So all of those combined together can create some pretty significant variations in farm income when we go from one year to the next. So income averaging has been around a number of years. This is an election that agricultural producers can make that allows them to average. I've got average in quotes. We'll kind of explain what that looks like a little bit later on, but they can average their elected farm income over the 3 prior years and essentially recalculate the tax that might or the savings that might have occurred had that income actually showed up in those 3 prior years. Now, there's two terms there that in the second point that I've got italicized. Farmers, we're going to define what a farmer is for income averaging purposes. I also want to point out that income averaging is also available to the fishing industry and to aquaculture as well. Now, I'm almost in the middle of Kansas. We deal almost, well, I shouldn't say almost nothing. We deal in no way with fishing industry. It is quite a ways to the nearest coast from here, but this provision, income averaging, does apply to fishermen as well. I've also italicized elected farm income. We're going to spend some time talking about what that is, what that means, and ultimately how income averaging works. I see income averaging as an extremely valuable tool. In the right circumstances, it doesn't always help every year, but in the right circumstances, income averaging can be extremely valuable. In my experience, I've seen very significant savings when we utilize income averaging, and so understanding what goes into this, how the basics of how income averaging is calculated, I think can be beneficial to both tax preparers and to taxpayers. Because this is more of a niche type of election, it is often misunderstood by both producers and by tax professionals. So hopefully I can give you just a little bit more information about how it works today and how it might be able to benefit you. I'll start here with some data that this is collected. This is actual farm data collected here in Kansas from 1970 through 2024. We're kind of finalizing the 2025 data, so that's not available yet. Um, I will point out that this is accrual net farm income, so it's not cash basis, and it's inflation adjusted to 2024 dollars. So the main reason I'm putting this up here is to show you the variability of incomes throughout the last, well, since 1970. 2021, fantastic year, at least here in Kansas, good yields, good prices, program payments, all of that combined to result in extremely high incomes. I think that you can use that as an example of how important or how beneficial farm income averaging might have been in 2021. We had an extremely high year. The three prior years were significantly lower, almost a third of the income in 21, going back to 2018 and 2019. Very, very beneficial tool at that time. So before we dive into income averaging, I want to take make sure that there's an understanding of how taxes are calculated, how the marginal system works. So with our federal tax system, federal income tax system, we do use a marginal system. So we have brackets, and as you bump into the next bracket up, income above that point is taxed at a higher rate. So as income increases, your tax rate, your marginal tax rate increases. That doesn't mean that all income is taxed at that highest rate. So we'll work through a little example here. So looking at a married couple filing joint, I've got all of our brackets laid out here. We'll start with the 10% bracket. That runs up to about $23,850. The next bracket up is 12%. So that's 96,950. And then we keep working our way up from there. So in this example, we've got $150,000 of taxable income, no long-term capital gain. We'll get to that here in a second, how that's impacted. We want to see what the overall tax liability is from that 150,000 of taxable income. So the first thing we're going to do, we'll start at zero and we'll start to fill in that 10% bracket. We've got $23,850 worth of room there. So we'll put the first 23,850 of that 150,000 into that bracket. 10% of 23,850 gets us a tax of $2,385. Then we'll fill in the next bracket as much as we can until we reach the total 150,000 of taxable income. So in this example, we can fill that second bracket, that 12% bracket, with $73,100 worth of income. 12% of that $73,100 is $8,772. Again, I'm going to emphasize that just because we bumped into that 12% bracket does not change the calculation on that first $23,850. It's still taxed at 10%. We haven't reached the top, or haven't reached our 150,000 of taxable income, so we'll continue this process until we put that 150,000 into we've filled up or utilized all of that in brackets. So in this example, like I said, we had 23,850 in the 10%, 73,100 in the 12%. We still have $53,050 remaining, and that falls into this 22% bracket. If we take 22% of that, it results in 11,671. So our total tax liability, when we add those up on that 150,000, is $22,828. So again, just wanted to kind of provide a little background on the marginal system, how that works, and how it looks. But so far, we've only discussed ordinary income, and we need to also consider capital gain. Now, our ordinary income in the farming and agricultural area, our our ordinary income is going to come from what's reported on Schedule F, the net result of Schedule F, as well as depreciation recapture that might show up on Form 4797. We're also going to include non-farm income like rent and interest and wages. All of that is ordinary income, and we'll lump that together when we do the calculations. Lump that with farm income, depreciation recapture, and so on when we do that income tax calculation. Now, the next step then is to consider long-term capital gain. So I'm going to focus a little bit on agriculture and where we might see long-term capital gain showing up. So in agriculture, well, in any part of our tax in realm, um, long-term capital gain is going to be the result of selling something for more than what we originally paid for it. And that's again, that's going to apply both farm and non-farm. Now, when I say something, when I sell something for more than what I originally paid for it, I'm referring to items that are capital in nature, meaning they are, you think of it as the pieces of the factory that is producing the output. So, buying a calf to resell, that is not going to generate capital gain because that's part of that's our output. That's part of the production process. What I'm referring to is the capital items, the larger ticket items that are used to produce our products. Land, machinery and equipment, and breeding livestock are the three big ones. Um, if I purchase one of these capital type items and I hold it for a long enough period and I sell it for more than what I paid for it, then I'm going to generate a long-term capital gain. With land, I have to hold that property at least 12 months to create long-term capital gain. Machinery and equipment, again, 12 months. Breeding livestock can be a little bit, it may be a little bit of an oddball. When we're dealing with cows or cattle and horses that are used for breeding purposes, I have to hold those for 24 months before it's considered long-term capital gain. If it's ewes or sows or something like that, it kind of reverts back to the 12-month holding period. Now, within breeding livestock, we've got to identify or make sure that the tax treatment or the long-term capital gain generated from a purchased beef cow, for example, is very different than the long-term capital gain generated from a raised beef cow. For purchased breeding livestock, I'm only going to see long-term capital gain if I sell that animal for more than what I originally paid for it. Just like with land, machinery, that sort of calculation is the same. However, with raised breeding livestock, I never paid anything for that animal. Um, I she was born on the farm. I put feed, other inputs in, raised her up, and now I'm using that cow, using that ewe for breeding purposes. Because I never paid anything at the beginning, the entire sale, the entire gain recognized by that in that transaction is considered long-term capital gain. So now let's take a look at how long-term capital gain is taxed. We do have separate brackets that we use to calculate long-term capital gain. There's only 3 brackets instead of 7 or whatever it is for ordinary income. And long-term capital gain, the rates associated with those brackets are lower than ordinary income would be. Um, I've many times heard people say that they want to avoid capital gain. And based on the brackets, based on the rates, that's not something that's coffee shop talk. I think that can be kind of confusing to people. So long-term capital gain rates are lower than ordinary rates and different brackets. The way we utilize these brackets is often confusing, even for tax professionals. For me, to think through this process can be somewhat confusing. So when we look at a bracket for long-term capital gain, we first have to fill those brackets with ordinary income. So essentially, what the amount that is taxed at long-term capital gain rates is what's left over in that bracket after we've filled that bracket with ordinary income. I'm going to provide an example here that hopefully will kind of illustrate that. I do want to emphasize we're not taxing that ordinary income at long-term capital gains rates. We're simply using that kind of as a placeholder to determine where the long-term capital gain fits in that bracket. So an example for 2025, we've got a married couple again filing a joint return. They have total taxable income of 100,000 even, but that 100,000 is comprised of 85,000 of ordinary income and 15,000 of long-term capital gains rate or long-term capital gain income. So the first step we need to do, and you can see the brackets here. The first bracket and what makes long-term capital gain beneficial from a tax standpoint is the first bracket is actually 0%. That's quite a favorable rate from a tax standpoint. I don't care who you are. If you can have income taxed at 0%, it's going to be beneficial to you. So that bracket runs up to $96,700. Then the next bracket is a big step up. That goes up to 600,000, and that's taxed at 15%. Anything above that $600,050 is going to be taxed at 20%. So let's look at this specific example. We're first going to determine how much within that bracket, how much is filled up with ordinary income. Again, we're not taxing that income in any way. That's already been done when we use the ordinary brackets. We're just using that as a placeholder to fill up that bracket first. So in our case, in this example, we had 85,000 of ordinary income. So that 85,000 is less than the top of the this 0% bracket. So we're going to fully fill or fully utilize that 85,000 of ordinary income, filling up that bracket. That means we have $11,700 left in that bracket that can be filled with ordinary income. That 11,700 then is taxed at 0%. 0 times 11,700 gets me $0 of long-term capital gain tax. Now, we haven't used up or we haven't taxed all of our 15,000 of long-term capital gain, so we need to spill over into the next bracket. That next bracket that runs from 96,700 to 600,000, We don't have any ordinary income to fill that bracket. We've already taken care of that. So that means we have $3,300 of long-term capital gain left. That's 15,000 less 11,700 that was already utilized. So 15% times 3,300 gives us $495 of long-term capital gain tax. Now, when I combine that with the ordinary income, and I'm not showing you the calculations, the calculation of the ordinary tax on this 85,000, but that tax would end up being $9,723. That's again ordinary tax, or that's the income tax on our 85,000 of ordinary income plus the 495 of tax we calculated on long-term capital gain gets us a total of $10,218 of total tax. So I just wanted to provide a little bit of background on how that long-term capital gain and how the marginal system works, because that's really important in understanding how income averaging works. Before we dive into the details, though, let's talk about some of the basics, who can use it, how it works. A few little background items first. Um, so I think it's many times today, well, the popularity of an entity, whether that's a partnership, a corporation, an S corporation, um, m many there's growing popularity to operate a farm business inside an entity of some sort, but only individuals, only a sole proprietor, well, only the only place that we can utilize income averaging is on an individual's return. They need to be engaged in the business of farming or fishing or aquaculture that I mentioned earlier, but they have to be engaged in that business of farming. They may be engaged as a partner in a partnership or a shareholder in an S corporation. In both of those cases, income flows through from that partnership, from that S corporation, and is taxed on the individual return. Now, to clarify, the partnership cannot use income averaging, the corporation cannot use income averaging, but that farming income that flows through to the individual partners, shareholders, that can be that income is available for income averaging. So again, a partnership, corporation, estate, trust cannot use by itself cannot use income averaging, but individuals associated with those entities, if they're passed through, may be able to. Let's look at what farm income is from how do we define income that can be averaged? Well, it's going to start with the net farm income that's reported on Schedule F. That's maybe logical, but in the tax world, don't assume anything is logical. We're also going to be able to utilize gain that's recognized in machinery and equipment, sales or trades, sale of raised or purchased breeding livestock. All of those can be counted as farm income that might be eligible for farm income averaging. Now, I've italicized recognized in that second bullet because if we sell a piece of machinery or equipment, then it's logical that the gain from that sale is part of farm income. But we also, since 2018, since the Tax Cuts and Jobs Act, if there is a trade of machinery or equipment, we have to treat that a little differently from a tax standpoint than what we used to. So if there's a trade, I have to treat the item that I gave up in that trade. I have to treat that as being sold. And then I have to buy the replacement for the full purchase price. There's no trading on of machinery and equipment anymore from a tax standpoint. So even though I gave up, say, a tractor in a trade, I didn't actually sell that. I still have to recognize gain from that trade. Now, the good news is that income is available or is eligible for income averaging. Um, I mentioned entities earlier, a farming partnership, a farming S corp, and farming LLC taxed as a partnership. If I'm receiving pass-through farming income from one of those entities, that may also be eligible for farm income averaging. And if I'm a shareholder in a farming S corporation and I'm receiving a wage, a W-2 wage from that S corporation, that may also be eligible for income averaging. Now, I do want to emphasize and point out that we cannot use gain from the sale of land. That is not included. It is specifically excluded as part of income that we can elect income averaging. So it would be very handy if that was, but gain from the sale of land is not income that we can utilize income averaging. Now, we've gone through some kind of definitions, some basics. I'm going to give you a couple more definitions and then we'll look at an example. Now, we have this large pool of potential income, potential or my farming related income that I might elect income averaging on, but I have to determine what my elected farm income or EFI, what the amount is. So that's the amount I'm going to essentially take out of the current year, spread out over the 3 prior years and average. So it doesn't have to be all of my farm income. In many cases, it's not. But I have to make a determination of how much I want to average back. When I average that back, I'm going to recalculate tax in those 3 prior years, and I'm going to weigh the difference. I'm going to, if I don't use income averaging, my total tax is this amount. If I take it out and recalculate those 3 prior years, I may see a reduction in that total tax, and that's what I'm going to utilize for. That's where income averaging is beneficial. That elected farm income can include both ordinary income, such as Schedule F, depreciation recapture from 4797. Both of those I can elect. I can also elect gain from the sale of raised breeding livestock and things like that generate long-term capital gain. Or I can do a mixture of both. I can do whatever suits, whatever optimizes, whatever maximizes my tax savings. Now, when I average things back, I don't get the option of selecting, all right, 3 years ago was my lowest income year. I'm going to put everything back to that. I don't have the option of doing that. When I utilize income averaging, I've just got to spread things out evenly over the last 3 years. And that applies to both ordinary income and long-term capital gain. Either way, it's spread out evenly over those 3 prior years. The difficulty with income averaging is that it is more of an optimization. So I'm trying to maximize my savings. And if I'm dealing with both ordinary income and long-term capital gain, after looking at the brackets earlier, you can see how things can get complex very quickly. Maybe I average back more capital gain, less ordinary income. What does that do to things? Or maybe I flip-flop that. Maybe I elect not to average back any ordinary income. Maybe it's all capital gain. And there's the again, the problem with that is there's no one right answer to income averaging. It's an optimization, and that is the piece that that I think people struggle with more than anything else. Um, I will caution if anybody tries to do income averaging with a hand-generated form, you're gonna struggle with this. I'll be blunt about that. Because it's an optimization, there's no one right answer. You will wear out your eraser trying to figure that out if you're working by hand. Okay, a few additional things. Um, If I elect to utilize income averaging, it's only going to affect income tax calculations. It doesn't change anything. It doesn't change the amount of adjusted gross income I report on my 1040. Doesn't change that at all, which that's going to impact, potentially impact credits, eligibility for other things. That adjusted gross income does not change because I elect income averaging. It doesn't change for the current year, and it doesn't change for those three prior years that I'm averaging back to. It does not change anything from a self-employment tax calculation. So if I have a very high Schedule F this year, that's going to generate a lot of, or potentially generate a lot of self-employment tax. Just averaging that back will not change that self-employment tax calculation. If I have NOLs in a prior year or this year, or if I'm utilizing an NOL that's not impacted by income averaging, and AMT, alternative minimum tax, is also not impacted. Um, I do need to be aware that if I elect to use income averaging this year, I need to keep track of that. And I need to know that for future years. In future years, I may elect income averaging again, and my choice today will affect the calculations then. So it's extremely important to keep track of that. It's going to affect those base years. It's going to affect the current year, and it's going to affect the following years. A potentially positive benefit of this is using income averaging. My filing status in the current year does not have to match those three prior years, so those base years. So if I was single in the three prior years, I'm married, filing joint this year, that doesn't matter from an income averaging standpoint. The calculations will remain the same. Or if the opposite is true, if I was married in one or two of the three prior years, and now I'm either single or filing separate, it just doesn't matter from an income averaging standpoint. I calculate the tax savings using the brackets that I was in that year. Excuse me. And I didn't have to be engaged in farming in those base years, in the prior years. So if this is my first year farming, first year in agriculture, and I have a great year and I'm showing a lot of profit, it doesn't matter that I didn't file a Schedule F in those prior years. I still can average back and I still can essentially utilize underutilized brackets in those prior years. Some of the details associated with this are more technical things. Income averaging is going to be reported on Schedule J. The official name of that form, Schedule J 1040, income averaging for individuals with income from farming or fishing. That you can use that as trivia with your friends at your next dinner party. The official term for income or official form for income averaging, I bet they probably won't know that. Um, I'm gonna um, maybe make a few editorial comments here next. I think Schedule J, in my experience, is an effective way to calculate savings from income averaging, but the form itself is a little bit illogical or maybe a little bit confusing. Um, it does work, and it works very well to calculate, but it's difficult to follow through logically. So just want to warn you a little bit of that. If you're looking at a prior return, looking at the return that your preparer did, and you're looking at Schedule J, it may or may not be something you can follow along logically with. Um, I mentioned earlier that what you do today with income averaging affects future years. So the opposite is also true. If you utilized income averaging in a prior year, you have to know that. You must know that. You must know the amount that was averaged either from or to that year to account for that in your in the current year current Schedule J. If there is long-term capital gain associated with either the elected farm income, if the elected farm income includes capital gain, or if capital gain, either farm or non-farm sources, it doesn't really matter. If there was long-term capital gain in those 3 prior years, um, then there's going to be additional worksheets involved. Potentially, you have Schedule J itself, which is a 2-page form. If the 4 years in question, the current year plus the 3 prior years, if there's capital gain associated with those, then we're going to have a 2-page worksheet for each of those years. So you're up to 10 pages of tax documents to utilize income averaging. That's where things get really complicated. Um, Another editorial note, in my experience, if I am averaging back long-term capital gain, the IRS struggles with that, to be blunt. There have been many times when I've seen them send back letters saying you calculated this wrong, you didn't do this, and it always has to do with the amount of long-term capital gain that is averaged back. I've spoke with individuals at IRS. I've tried to convince or tried to understand how they calculate, um, I've struggled with that. I just don't know. They struggle with it. Um, it can be frustrating. Um, so I want to warn you that if you're utilizing income averaging and you include long-term capital gain in the amount in the elected farm income, it is possible that you're going to get a notice from the IRS that say you did this wrong. We're doing this to adjust things, and just be warned that that may be the case. Let's take a look at the form real quick, and then we'll look at an example. So the basic layout of the form is your current year taxable income before income averaging is line 1, and then you report your elected farm income on line 2A. That is the amount you have determined that you want to average back over the 3 prior years. Within that, 2B, line 2B is where you report the amount of long-term capital gain that is included in line 2A. So line 1, we're going to subtract off line 2A, and that amount then is reported on line 3. And we're going to calculate the tax on line 3 using 2025 rates. Then we need to look at the 3 prior years. So we're going to start with 2022. the oldest year, the third year back. This line 5 is the amount that would have originally been reported, the taxable income that would have originally been reported. Line 6 is 1/3 of the amount on line 2A. Remember, I said that we're spreading it evenly over the past 3 years. So we're going to take 2A, divide that by 3. That's going to end up on line 6, on line 10, and line 14. We add the tax, or add the original, add the amount that was averaged to that year to the amount that was originally reported. That gets us line 7. And then we calculate the new tax on that. The additional tax that that would have been reported had that 1/3 of the elected farm income been reported in that year. Then for the second page of 1040, we're reporting the tax amount, or the amount of tax that was originally reported in those 3 years. In the end, what we're doing is calculating a difference in tax that or the amount of tax that we are saving by utilizing income averaging. Again, as I mentioned earlier, it's not the most logical form, but it does work well to calculate averaging. But maybe to give you a better example of how this works, I'm going to present it a little bit more graphically. We've got in our example here in 2025, we've got $132,950 of taxable income. If I don't utilize income averaging, if all of that is ordinary income, that's going to result in $19,077 of tax. In 2024, I had a poor year. I only had $17,000 of taxable income. Income tax on that in 24 was $1,700, $50,000 of taxable income in 23. My tax that I paid in 23 or for the 23 return was $5,560. And in 22, I had a good year again, $100,000. And that year I paid $13,234 of tax. In total, over the 4 years, without income averaging, I would pay total tax of $39,571. But how does income averaging help me? So again, a graphical look at that. I want to point out that it's probably a little bit hard to see on your screen, but I have indicated in each year the top of the 10% bracket and the top of the 12% bracket. So those are all indicated here. In 2025, you can see that I'm well into the 22% bracket. But in 24, I'd not even filled up the 10% bracket, much less the 12% bracket. In 2023, I still had a lot of room left in my 12% bracket. Going back to 22, however, I was over the top of the 12% bracket. So I was into 22, I paid tax at 22% in that year. So what happens if we average, looking from a graphical standpoint, how does this work? So I'm essentially going to take the amount, just in this example, I'm going to take the amount that I'm above the top of the 12% bracket, which in this case happens to be $36,000. I'm going to spread that evenly out over the 3 prior years. And at least for right now, I'm just going to look and see if I can tell if there might be some savings. So the first $12,000 I took out of 2025, I took it out of the 22% bracket, and I'm adding it to the 22% bracket in 2022. So Going from 22% tax to 22% tax, I'm not going to save anything. It doesn't make any difference. There's no savings. However, the next two thirds, um, the next third I'm putting into 2023. I'm taking it out of 22%, out of the 22% bracket in 2025, and I'm putting it in the 12% bracket in 2023. So I'm saving 10% on that $12,000 that I've averaged. I'll do the same thing again for the last third of my income. I'm taking that out of 22% income, or 20 out of the 22% bracket in 2025. And part of that is going to be taxed at 10%, and part of that is going to be taxed at 12%. So a portion of it I'm saving 12%, a portion of that I'm saving 10%. So I'm going to expect that I'm going to have some savings from income averaging in this example. Let's go through the math and see what that looks like. So I started with my 132,950 of taxable income in 2025. I took a full 36,000 out of the current year. That means my new taxable income for 2025 is 96,950. I had originally paid 19,700. I'm now paying 11,163. So by removing that 36,000, I'm saving $7,900. Now, the other 3 years, I'm adding income, so I expect tax to increase. I had 17,000 in 24. I added 12,000, gets me 29,000 taxable. The new tax on that is $3,016, so I've added $1,316. In 23, I add 1,440. In 2022, I add $2,640. But when I total everything up, I'm saving $2,518 just by electing income averaging in this example. So sometimes the savings is minimal, but sometimes the savings is very significant. So again, income averaging is a very, very beneficial tool for ag producers. So the last thing I've got here, or the last image, I guess, is what that Schedule J might look like for the previous example. Start with my 132,000. I remove 36,000, recalculate that, work through the form, and Schedule J is calculating a tax of 16,559. Remember I said that my original calculation was $19,077. So the difference between those two is the amount I save utilizing income averaging. Again, that's this $2,518. Okay, some closing thoughts, and then I'll attempt to answer some questions. I know I kind of sped through this, but hopefully it's given you an idea what how the basics of how income averaging works. I've said this many times. It's a valuable tool for producers. I firmly believe that we always want to look at utilizing income averaging if there is farming activity on that 1040. Always, not always going to result in a benefit, but we always want to look at that. I mentioned earlier, optimization is part of this. It's not one number, it's not one answer. There may be several different paths or several different amounts of elected farm income that get me to a similar result. if I'm going to include long-term capital gain in that EFI, in that elected farm income, it's going to create complications, not only from a calculation standpoint, but potentially further down the road. I need to be aware of that. And I think it's extremely important if you are either if you're working on your own return or if you're working with a tax professional on your return, make sure that that tax professional understands agriculture in general. Things are different for agriculture than Main Street businesses, but also understands the complexity of income averaging. So, I told you this might be shorter than what you're used to. I rambled on for a long time, longer than I thought I would. Um, so I guess we have a few moments for questions. Um, I'll see if I can look here in the chat and see what those are. Or if Janet or Ruby or someone else wants to read off questions. Um,
Hi, Mark. I can do that for you. One question is, how does weather or crop failure impact income averaging decisions?
um, Well, I think the impact is if we have poor weather, if we have drought, and low yields, um, then I'm potentially at a point where in the future, when I do have, assuming that that year that there's drought, that there's a crop failure, that I have a lower income, um, I'm potentially at a point where I will have more room in the future to average back. So I want to keep that in the back of my mind that I want to make sure that in the future I'm looking very closely at income averaging and seeing if that helps me when I have that low year, I'm underutilizing brackets, that maybe I can fill some of those up and save some tax at that point.
And how does income averaging compare with other tax planning strategies like deferring income or accelerating deductions?
That's a good question. There's one benefit I think to income averaging that maybe with that we don't always have with deferring income, and that is it can be done after the fact. I don't have to make any decisions through the tax year to to decide, hey, I'm going to average this year. I need to do something different before December 31st. That happens when I'm working on the return, when I'm completing that tax return. So it's an after the fact decision. But I can utilize that with deferring income, maybe stacking, maybe I can plan to keep things low for several years and then stack one year really high, average back. There might be some getting into the weeds a little bit. There might be some benefit from a self-employment tax standpoint to utilize that strategy, but not something I'm necessarily recommending. But it does kind of go hand in hand with other tax planning. Um, I will say that before you get to um, relying on income averaging, tax planning at year end is probably a much more important strategy than income averaging. Knowing where you're at before year end, have a target for December 31st, and knowing what you need to do to get to that target, that is a much more valuable strategy than income averaging by itself. So,
Okay, and I think for the most part, everything else was at some point covered in your presentation. If anybody
okay.
has another question, here quickly drop it in the chat.
I do see one, Janet, here. And maybe I mentioned this um, in my presentation. Can a farmer use income averaging every year? Yes, every year. There's no limits on that. I can use it every year that benefits me, and no, doesn't matter. how many years, if I use it or don't use it, it's unlimited.
And since you've answered that one, no one else has put anything else in the chat.
Okay. Well, my email is on the screen. I think you'll have um, the an email for rural tax is down at the bottom. You feel free to reach out with additional questions. Um, and I appreciate everybody taking the time today. Um, Not a glamorous topic, not exciting. I'm not sure which tax topic is glamorous or exciting, but I do appreciate the time you've taken.